All right, we're going to finish up this chapter with this last video, starting with slide 26. We're going to talk about here buying on margin and selling short. First of all, buying on margin is essentially borrowing money from your broker to buy stock. Now, you have to have some equity in the deal, just like buying a home. If you have some cash in your account, and first of all, there's two different types of account. There's a cash account, and then there are margin accounts that are set up with the appropriate disclosures and documents signed to allow an investor to buy stocks on margin. So the FINRA, the Financial Industry Regulatory Authority, which is organized under the Securities Exchange Commission, sets margin requirements. And there are two that you should be aware of. There's the initial margin requirement. And hold on, here we go, the initial margin requirement. And then there is a minimum maintenance margin. I guess it's on the next slide. Regulation T controls this. The minimum initial is still currently, this slide is correct, 50% for stock. So that means an investor that wants to buy $10,000 worth of stock, if you've got $5,000 in your account in cash, you can buy $10,000 worth of stock. So the broker will loan you the other 50%. So that's the most you could buy. And brokers can set more stringent requirements, but Regulation T, it says here, is set by the Federal Reserve. FINRA speaks to that as well. If you have 5,000, you could buy 10,000 in stocks, which is the meets. So margin actually means your equity. Here it is, the minimum percentage equity the investor has in the account. Okay, so happily for freewheeling speculators, if you were to buy at a 50% margin, you only have $5,000 equity in a $10,000 trade. If the price of that stock begins to decline, your equity declines with it because you still owe the amount that you borrowed from the broker, the other $5,000. But happily for speculators, this maintenance margin goes down as low as 25% is the minimum that FINRA and the Fed allows. So the stock can decline further without you getting what's called a margin call. A margin call is when you get a notice from the broker, you've got to put more cash in your account or the broker will sell your shares in order to satisfy the loan that they made you to buy those shares. Now, if this sounds risky, it is. I strongly recommend against it. Margin accounts should only be done by professionals that really know what they're doing. This brings to bear leverage. So you're leveraging your 5,000 by borrowing 5, and if you're just sure a stock is going to go up, that's when an investor would utilize margin. But we're usually wrong about 50% of the time, so it's very risky, and again, really discourage margin. So the next couple slides go into the math of how to calculate your minimum maintenance margin. I'm not going to require you to be able to solve this. It's not really complex, but I don't see the value in you memorizing this. But I am going to point out, this is sort of a little balance sheet down here. And you'll notice that here, your little balance sheet, you own $70,000 in stock. You borrowed half, and you have equity of half of that. So your initial margin here is indeed 50% in this illustration. So now if the value of your stock falls from $70 a share to $60, the amount you borrowed, you still owe, which was half of that $70,000. 1,000 shares times $70 is now worth only $60,000 because the share price fell. You still owe the 35, so your equity has fallen to $25,000. So now your margin or your equity, the percentage you own, is only 41%. You started at 50%. So you can see the negative here of what happens when you go on margin. The leverage works either for or against you. So at a 40% margin, a maintenance margin requirement, the stock can go down to 58,333. You bought this at $70 a share, 1,000 shares. It goes down below 58,333. You're going to get a margin call. That means you've got to put more cash in your account. Now your balance sheet should really say over here 58,333. I can pencil this in. 333 is your asset. And so you still owe $35,000 and your equity is $23,333. So you can see you've now hit the minimum maintenance margin of 40%. Again, you're not going to have to calculate this, but I want you to see how margin can work against you. So here you can see, unfortunately, the author changes the illustration now to a situation where you bought where the investor bought $20,000 of stock, and that's made up of 10 in a loan and 10 of equity over here. So if I can get my 1,000 sign there. So in this case, scenario 1, the stock goes up 30%. So the $20,000 becomes $26,000. Isn't that wonderful at the end of the year? But you still owe the $10,000 plus 9% interest right here on the loan. So if you do the math on this, you made a 51% return. The investor ends up with a $5,100 profit, and they invested $10,000 of their own money. That left a 51% rate of return. Now, even if the share price ends the year the same as it began, or the value of the account, you still got to pay back your principal and interest. And $10,000 of that was just paying off the money you borrowed, but the $900 was a new expense, was interest. So $900 divided by our $10,000 investment, we lost 9%, even when share prices didn't change. So that highlights the risk here of this type of leverage. And it really gets bad when prices go down. In this case, you end up with a 69% loss if share prices only go down by 30%. So again, really discourage you from dipping your toe in the water of margin trading. Last major topic in this chapter 3 is short sales. So we normally think of, in the stock market, of buying a stock and sometime later selling it. Well, you can reverse that process. You can actually sell a stock you do not own and later buy it. And that is called selling short. That initial sale of shares you don't own is selling short or without the stock. The mechanics are that the stock is borrowed from the broker, and the investor must post margin. 150% of the value of that transaction must be in the margin account. So the broker actually borrows the stock from another investor that owns it, and when they sell it, the proceeds are deposited into your margin account if you are selling short. Later, when you buy the stock back, that's called covering or closing out the short position, and then the title goes back to the original party. Actually, most brokers, when you buy a share of stock, it's not put in your name. It's held in the name of the firm, called their street name, the street name of your broker. So then they can easily access those shares to loan to another party who wants to sell short. Okay, I know this sounds a little complex. You might want to read about it in the book or Investopedia. But at any rate, that's the way a short sale works in the basics. If you were to sell shares of a stock short, so you borrowed the broker had borrowed the shares from another account, loaned them to you. If a dividend is paid, that's got to be paid back to the original holder. So you do not earn those cash flows because you borrowed the stock to sell short. Again, margin requirement's usually 50%. So if you were to sell 100 shares, $60 stock short, then at a 50% margin, that's $6,000 for the cost of the stock. $9,000 is the 50% margin requirement pledge. So you have to have $9,000 in your margin account in order to do that trade. So of course, the equity you have in the trade is the total margin account of $9,000 minus the market value of the shares, which is $6,000. So the investor has $3,000 of equity, short sale equity at that moment. So the maintenance margin on a short sale is 30%. Initial margin requirement is 50%. If your equity as a short seller fell to 30%, you would have to put up more equity into the account, into that margin account. Again, I'm not going to ask you to memorize this math. Just be familiar with the terminology and the concept of how it works. You're not going to have to know how to calculate the price that would trigger a margin call. You don't have to know how to calculate that. Or how much it takes to get back to the 50% initial margin. Just understand this concept and you'll be good. So here we're going to compare the process of purchasing a stock versus short selling a stock to help you understand the concept a little better. So if you were to purchase a stock, you initiate that by buying a share of stock. That costs money out of the pocket, negative cash flow there. When a dividend is received, or when you sell the stock, then you have another cash flow. You receive the ending price you sell it for, and you receive dividend cash flows. So very straightforward. That's the process you're accustomed to with purchasing a stock. When we short sell a stock, the first action is to borrow it and sell it. And when we sell it, we get a positive cash flow into our margin account. And the other actions that can happen is we have to repay a dividend, and we have to buy the shares. When we want to close this transaction, we have to buy a share to replace the ones that we borrowed because we'd only borrowed them. So in that case, negative cash flows are paying the dividend back to the original investor. That'll come out of our margin account. And of course, the ending price, when we cover or to close out that short, covering means that we have to buy, and that costs us money here at the ending price, ending cash flow. So that's a negative cash flow. So you can see that with the purchase, begins with a negative cash flow, ends with a positive. Short sale begins with a positive cash flow and ends with a negative. The last slide we're going to cover on Chapter 3 here is about regulation. And I mentioned earlier FINRA. FINRA is what's called a self-regulatory organization. So it was created by and ran by all the member broker-dealers, financial institutions. However, the SEC has oversight. I mentioned that earlier, that they oversee FINRA. But so FINRA does the licensing of stockbrokers and so forth. And so they're kind of the first level of oversight for the industry. And then the Securities Exchange Commission oversees them. I mentioned the Sarbanes-Oxley Act earlier, and that has created significant regulations, particularly the CEO and CFO have to personally sign and are personally responsible for the financial statements of publicly traded companies. Regulations also prohibit insider trading, and that is in people who have non-public information cannot trade with on that information. They can't buy or sell because they know earnings are going to change or something that the general public does not know. Neither can they pass that non-public information to anyone else legally. It does occur, and it's well documented that insider trading occurs, and the book mentions 3 forms of evidence of insider trading. First of all, there have been convictions of insiders that did trade on information that was non-public. Also, if you compare the profitability of insiders on their trades versus non-public, they do much better by about 5%. Also, anytime there's good news, you can observe this yourself. If you look at a stock chart, let's say earnings doubled for a company, if you'll look the several days leading up to that, the price has already started moving up of that particular security, which tells us somehow word is getting out because it's pretty consistent. So even though it's illegal, regulators have had a very tough time enforcing insider trading regulation. So that's the end of chapter 3. I encourage you to read the textbook, and we'll pick up chapter 4 later. But in the meantime, I want you to remember, if you want to be successful financially, you've got to spend less than you earn and save some money to invest for later. So I'll see you next time.